G'day and welcome to the Investor Motivation Podcast. Rach, welcome.
Thank you.
Good.
How are you going? Friday afternoon.
Yeah, Friday afternoon, and we thought we better get a podcast done to have a chat about, what are we chatting about?
Things to look for, I guess, or what you should start doing when you hit retirement, things to look out for. We'll just have a bit of a chat and see where that lands.
Fantastic. So, it's not about retiring in 5 or 10 years. It's about you're about to retire now. What should you be doing? What will physically happen? And I think for most people, we need to consider, do they need advice or not as an absolute starting point?
Yeah, and that is a hard one to work out sometimes, because you may think you're on top of everything, but changes in legislation, different strategies, things that we study day in, day out, or accustomed to.
Yep.
The everyday person is not going to know it all.
Absolutely. And the people that we catch up that do come in to find out whether they need help or not, often they don't know what they don't know. And even those people that are really, they are 85, 90% there. There are often a few gaps where they can benefit from advice.
Absolutely. Yes.
So let's assume that someone needs some advice, Rach, and they're not just you're going to wing it themselves and hope for the best. Where do we start? What do we think as financial advisors what clients should be doing?
First thing is, I suppose, the structure in which they will hold the assets. That's a big one. So whether it's superannuation, outside of it, annuities, all those types of things, and then I guess income needs and also what their goals and objectives are. So there's a lot of things that we take into account, but I think we'll start with the first one being, where do they hold the funds? Right.
So what entity is that? So clearly the best entity from a tax point of view is going to be
superannuation.
It's going to be super, and super for many younger people, it's pretty scary because you've got limited access until you're age 60 and meet a condition of release. Between 60 and 65, and if you are age 65 working or not, you have full access.
That's right.
But from the 1st of July 2025, you can have up to $2 million in superannuation in a retirement pension, an account-based pension, and that is completely tax-free.
Yeah, it doesn't get any better than that, that's for sure.
So there's lots of noise around at the moment around the $3 million and the new legislation, which is looking to come in above 3 mil. But if we, if your husband and wife can have $2 million each, that's completely tax free. It's still pretty generous.
Absolutely, yes.
Yeah. So whilst there is what we call legislative risk, for those that have got access to super, it's nearly got to be a first option.
Yeah, definitely. Yeah.
What would we do with money outside of superannuation range? So what we can't get in, or if they're lucky enough to both got to $2 million. Yeah,
so we then start looking at investing in their own names, so whether or not it's a direct share portfolio or other means. And then in some more complex scenarios, you might have a trust structure, but
And that's where you want more flexibility. So we've maxed out super to have tax-free, because we can't get a better tax rate than that. And if the amount of money in it outside of superannuation is at a certain level, you'd like the flexibility to distribute to multiple beneficiaries.
Yes.
That's where an investment trust, family trust, may come in as a great option.
Yes.
Yep. Very good. And that means essentially a family trust you can distribute to the mum and dad, the couple, and then to other beneficiaries, children, future adult grandchildren, and so on, to help smooth out the taxable income.
Liability,
Yeah. And if they're, let's say the investment assets outside of superannuation is not that massive, and you just can't get into superannuation, you tried, and the income that comes off that is say $20,000 shared between two people, there's no tax problem there, is there?
It's not going to create an issue at all, so
Right, because each individual in Australia can earn $18,200 completely tax-free. When people retire and get to age pension age, there are other low-income tax offsets as well that increase that number quite a bit.
Yep.
Fantastic. So that is the tax structure side of things. That is obviously that's where we start. So superannuation has got to be obviously a big part of this. What about centerlink, the age pension?
Yeah, so that's certainly one that we're looking at as well. Things that we take into account is there may be an age gap between the couple, so we may look at strategising, putting more money into the younger spouse's name, keeping that in accumulation.
Okay, explain that please. Why is that good?
When it comes to the asset tests, if you're underage, so say partner's pension age,
yes,
age 67 and above, anything that they have got in their name is included in the asset test. If the spouse, the younger spouse, is not age pension age, any funds that they have in accumulation within superannuation is exempt from the centerlink asset test. So we can look to load up the younger spouse to then increase the amount potentially they can get.
Cool. So we're talking about a scenario where someone is age pension age, 67 and above, and the spouse, the partner, is below that. It gives us a certain amount of time to strategise to maximise centrelink.
Yeah, and then of course once they're both 67, then it's all included. So.
Cool. And this is all about, I suppose, spending the government's money first before your own, which helps maximise how long your own money will last and money will get to your beneficiaries as well.
That's right.
Yep.
Yeah.
Very good. Centrelink, what other strategies can we look? Obviously, if there's not an age gap and their assets tested and they get a little bit of pension, what other things can we do?
Yeah, so you can look at things like guaranteed annuities. So at the moment, around 60% of that overall amount is included in the asset test. So these annuities can give a reduction for Centrelink purposes. There's boring things like the funeral bonds.
Oh, what an exciting retirement asset that is.
Which is currently around $15,500. So if you've got one of those, that's exempt as well from the asset test. There are tweaks where, again, you can maximise potentially what you get.
Yeah, and I can hear people's excitement. A funeral bond as a Centrelink tax planning strategy is not very exciting, but when we think about the flow-on effect, that if you put, so every $10,000, say you get a small amount of pension, every $10,000 that we can hide from the assets test adds $780 per year in age pension.
Yeah.
That's 7-8% return.
That's right.
So
risk-free.
That's right. It's that's guaranteed. And obviously, I'm not a fan of people having funeral bonds for funeral bond's sake.
No.
But for Centrelink, it sort of does start to make a bit of sense. It increases income.
Yeah.
And the lifetime annuities, these are lifetime assets that you will purchase an income stream that will pay out for the rest of your life. And the stats actually show that these people that have these lifetime products where it pays out for the whole of your life, they live longer.
They live longer because they're stubborn.
Because they're stubborn and they want the company to pay for a long time.
That's right. Yeah.
So we love stubborn. What about gifting rules? Is that much of a help?
It can be. But you've got to make sure you play within the limits, of course. So up to $30,000 you can gift over a 5-year period, being the maximum of $10,000 per year. So if you have the ability and it doesn't jeopardise anything else, then gifting can be an option to help out as well.
So what you mean by jeopardising is your own
retirement? Yes, that's right. You don't want to be gifting for the sake of gifting and then it's at your detriment. And you then run out of money. Yeah. So how would you prove that it's not going to be at your detriment? Projections, of course, Rob. Of course. Well, I suppose explain what we would physically do there. I think Rach would be how we use projections, and if someone says, I'd like to help out the kids now. Yeah. Not just for Centrelink, but to help the kids. Yeah, that's right. So we, look at the overall assets, what they want to spend for themselves, what their goals are and expenses are. And then, we can key in there, okay, what does it look like if we gift to the kids now or down the track? There have been scenarios where we've had to say, look, it's great, you want to help your kids out, but now's not the time. Okay, fantastic. So we set up the tax structure, make sure we pay as little tax as possible. I think everyone agrees with that. Over their working life, people have paid a lot of tax. We then want to make sure that we
getting some of that tax back through Centrelink if
Yes.
available.
Yep.
Spend the government's money first before your own. And now, what about investment? Now, the way we invest when we get to retirement now, we always have big discussions around this point. There, life cycle investing, things get more conservative as we get older. And for us, for me personally, that is just a lack of education, I believe.
Yeah, we definitely challenge those conversations for sure.
Yeah, and what I mentioned, life cycle investing it happens particularly within industry funds. As you get from 50 onwards, you'll go from high growth and progressively move yourself into more conservative assets.
Mm-hmm.
And by the time you get to 65, you've got a big chunk of your money in assets that won't grow. And the whole idea is there that it takes away the volatility. So it takes away the volatility of the share markets and the ebbs and flows, but it also takes away from your
growth,
your
the
growth
returns,
and your return, and it affects how long your money will last. So getting education around investing, where to invest to get the best result over your lifetime is, I think, you get these other fundamentals right, tax structure, get Centrelink right, then learning about investing, investor psychology, investor emotions is really key, and it's the most difficult part of our job.
Yeah, that's right.
Yeah. And I think it was, we've been very cautious with our new clients not investing terribly much at all-time highs. And when we saw with Trump's, I suppose, tariff shenanigans, we got this, 2 or 3 day window where we did do some buying, and and at that time no one was really interested in buying, but we were for our clients because all the news was bad, and that's where the opportunities sit. So, dialing down to more conservative assets as you get into retirement, when retirement could last for 3 decades, there's a huge risk.
Yes,
and that huge risk is inflation. Mm-hmm. What's next, Rach?
When's the right time to spend more? So you talk a lot about these with your go-go years. And
do we use projections again to help with that?
Yes, Rob, we do use projections again. I guess educating people when to spend. We've spoken a lot about it, spending more while we're mentally, physically able.
Yep.
So, guiding people through that with the projections. Helping them work through the emotions of the fear of running out, overspending, not spending enough. Trying to gauge, when is the right time to spend.
Yeah, and of course, the projections that I bang on about a lot because they're important can also help people know when to retire. And a good case study yesterday was we were talking with our clients, and they had their goals. We would like to have a gap year from work, then reassess when one of their children finish year 12, bit of an adult gap year, think about whether they come back or not. Can I do it? So we used the projections to prove whether they could or not. We took into account in future inheritance. But at the start of their relatively early retirement, we had a base expenditure of $80,000 per year.
Yeah.
And then for the first 15 years, we had an extra 25 grand.
Perfect.
And this is what we're modelling and projecting out. And we could see that with the assets they've got now, and also the future inheritance and differing returns, often quite conservative returns, that we could prove that they could do it.
Yeah, I can just imagine the excitement on their faces and the relief when they walked out, because knowing that they can make those choices and have less regret down the track. So,
absolutely. Spend 80
memories.
Base living, and your advisor saying spend more, please. It's exactly what you want. Now, the emotional and obviously the lifestyle side of retirement, we see a few particularly retired men struggle a little bit, Rach. Can you just probably give a little bit more colour around that? Yeah,
we do give the men a bit of a rap about it. But I think it comes down to with the women as well, or females. It is a huge transition, because it's all of a sudden you're tied up, it's your identity that's tied up in your workplace, your social connections, all those types of things. that it can be quite tough to transition across. And a lot of people that I speak with, they say we didn't take into account the emotional side of it. We were too fixated on just the financial side. Both are equally important.
Yep, absolutely.
And having that purpose, because it is a massive change. It's one of the biggest changes that you'll go through in your life.
Yep, absolutely. And I have, over my career, I've seen addiction to alcohol, pokies, depression kick in.
Relationship breakdowns,
It can be a tough time, and I think there was a saying that one of our other advisors, Olivia, would say, you need something to retire to. And I openly admit I do love my job. I am a great candidate to be, what's my purpose now? Where's my identity now? Because I do like my job and I'm all in, so I'm definitely one of those men that's at risk. And hopefully, my taking up what was my old job as a potter and turning that into a fun hobby.
Yeah, being creative, finding a different way, a different outlet.
I need to get that pottery set up.
Yes, you do.
Yeah, so that's one thing that we are really watchful of and coaching of, to make sure that people are knowing of the risks that are ahead of them.
That's right, yeah.
Fantastic. Yeah. Rach, I reckon that is a reasonably good summary, short, sharp and sweet. Rach, where can people find you if they're on socials?
Yeah, so Instagram and TikTok under Rach Todman.
Cool.
What about yourself?
Instagram and TikTok. And obviously, for those who are listening to the podcast via a podcast player, check out Investor Motivation, which is our YouTube channel. There is 750 plus videos there, the labour of love since 2012. Thank you very much for listening. If anyone has got any topics you'd like us to cover, please let us know, and we are happy to do that. And until then, we'll catch you next time, and thank you for listening. Cheers.
See ya.
See ya.